Retirees who are not aware of these three massive tax torpedoes as they enter into an attempt to navigate retirement often get surprised by at least one of them as they go through their retirement years. Having your marginal tax rate effectively jump to 27% when you were expecting 12% is not where you want to find yourself. And most CPAs aren't taking the time to help you understand these risks ahead of time. By the time they're preparing your taxes for the previous year, that's too late. Yet these tax torpedoes are certainly not beyond your comprehension. So let's dive in so that you can be prepared. Welcome back to the smartest 18,000 financial minds on YouTube. For those of you who don't know me, my name is Steven Spicer, and it's my goal to help you not get killed in taxes and to overcome the significant risks to which mainstream advice leaves you exposed. In this video in particular, obviously we're talking about taxes, specifically tax torpedoes. Now, a tax torpedo is simply an unexpected bump in the effective tax rate due to the phasing in of a tax or the phasing out of a credit or deduction. Okay, they don't necessarily need to be avoided at all costs or anything like that, but being aware of them could save you tens of thousands of dollars throughout retirement and at least help you not get hit with a surprise bill to the IRS come tax time. Now, as we go through these three, an important underlying theme is that it's not just the tax bracket that you're in that matters, right? A lot of times people just think in brackets. I'm in the middle of a 22% bracket, so the next lump sum I pull out of my traditional IRA is going to be taxed at 22%. That seems straightforward enough, but of course, as with anything where the government is involved, it's not that easy. What's more important is the effective tax rate of the next dollar that you'll pull from your accounts. If you pull $1,000 extra in a given year out of your retirement accounts, causing your ordinary income to go up by $1,000, and that one move alone causes you to owe an additional $400 come tax time, I don't care if you're in a 24% tax bracket. The effective tax as a result of that additional $1,000 being pulled was 40%, $400 of your $1,000. Think about that. Say it's December 30th and you've pulled out enough throughout this year to put you squarely in the 12% tax bracket, and you would like to withdraw another $20,000 to buy a new boat. You're comfortable with the $2,400 in additional taxes that a 12% tax would imply, since you feel pretty confident that's the bracket you'll be in next year as well. But what if the actual tax rate on those next $20,000 is 30%. So you'd end up owing an additional $6,000 in taxes instead. That's 2.5 times more than what you were expecting to have to pay. Are you still okay with that decision? Would you still do it, or would that awareness, that understanding, that knowledge help you make an informed decision to wait just 2 days in this instance until January 1st to make that withdrawal instead? Well, these are the types of real life decisions we're talking about here. Whether it's just a thing or a vacation or anything that you want and you're trying to figure out the best time to make a withdrawal or which account to pull from a long-term tax planning perspective, or if we're talking about Roth conversions you're interested in pursuing because of some YouTube video that you watched, you need to be aware of these risks. All right, so let's dive into the specifics. We can dive into the first one here, the one with which, if you've heard of tax torpedoes at all, you're likely already familiar. I'm talking about the Social Security income tax torpedo. Now, we talk in a different video about the way Social Security is taxed. $0 of it can be taxed, all the way up to 85% of it. Remember, that's not an 85% tax. It's just that 85% of it will then be subject to tax, right? For context, for comparison, your normal earned income has always been 100% subject to taxation. Your withdrawals from your traditional retirement accounts are 100% subject to the ordinary income tax. So Social Security is just weird in that it starts out not being subject to tax at all, but as your income level moves up in a given year, once it crosses a certain threshold, now all of a sudden, for each extra dollar of income you realize, more and more of your Social Security is potentially being subjected to tax, up to, as I said, 85% of it. The specific threshold breakdown looks like this. So check this out. Say you're in retirement with about $27,000 of Social Security income, a couple of other small sources here and there, but your reported baseline income is only a little bit more than $17,000. Well, this chart shows the tax rate for the next $1,000 of income. You know, like we were talking about before, if you decided you wanted to withdraw an additional couple $1,000s before the end of the year, it would be worth seeing where you fall with something like this. You see, the next $1,000 of income would come with a 0% tax. Great. $2,000? Same story. $3,000? Same. By $5,000 of additional income though, even though you might technically be in the 10% tax bracket, every dollar of increase is being met with an 18.5% effective tax rate. So instead of your $1,000 withdrawal being worth, well, $1,000, you're losing almost 20% of it, in this case, $185. So if there is a way to delay that withdrawal until the following year, this one observation, this one understanding might just save you thousands of dollars. This whole purple bump here, this tax torpedo, if you will, is your Social Security income moving from having none of it counted in your taxable income to the max of 85% that the government taxes. Many of our clients have converted a significant chunk of their old IRAs and 401ks into Roth accounts before they turn on Social Security income. Being aware of this tax torpedo and the implications of turning that income stream on earlier rather than later can help you make an informed decision around important planning considerations like that. Then when their Social Security income is flowing, some are able to stay under that IRS income threshold most years while still living their best life because so much of their money is now in tax-free accounts. That's pretty valuable planning. The next torpedo you've got to worry about is Medicare Part B premiums. This isn't technically a tax, but it is a decent chunk of change that you are going to be on the hook for if you earn even $1 over their line. There is no phase in at each of these levels here. So you need to be aware of where those lines are, because once you cross this first one, for example, you pay an extra more than $800 per year. That's like an 81,000% effective tax rate on that $1. That doesn't mean it won't be worth it, but you certainly should be aware and factor it into your decision, your cost-benefit analysis as you're pulling out money. I've seen and met with so many retirees who are entirely surprised, taken aback by the new higher Medicare rates they are going to have to pay this next year. That should never be a surprise. That should already have been factored into the equation before doing what it was they did to bump them up into that higher level. Actually, Part D is the same way. It's not as much though, $934.80 more per year at the highest level. But yeah, so with those two parts combined, that's a roughly $6,000 per year scaled increase for which you should be accounting. It's based on the amount that the IRS says you earn a couple years prior. If we extend our range here, you see the first two levels of this adjustment show up on our chart here as these dotted lines. The first one here is reminding us that if this couple adds this much to their income this year, they're going to cause their annual Medicare premiums to go up by $993.60. At this level up here, $2,496 extra per year. You've got to be aware of these things or have somebody you trust on your team so that you don't get blindsided by tax torpedoes like this one. By the way, this brown one up here is another one. It's another tax torpedo, but it's smaller and doesn't seem to upset near as many unsuspecting retirees. And we don't want this video to be too long, so we can ignore it for now. But hopefully you and your planner aren't ignoring these things. Anyway, let's instead move on to our final, at least for our list here today, torpedo, the sneaky capital gains bump. This one catches a lot of people by surprise, and a lot of that has to do with confusion around how long-term capital gains are taxed. Hopefully, this will clear it up. The oil in here represents your realized taxable long-term capital gains for a given year. Right, you see that down there? This line this arrow, represents the first threshold for when long-term capital gains go from being taxed at 0% to being taxed at 15%. It's a big difference. Right now, as you can see, they are solidly in that 0% range. So let's add some ordinary income to this tax equation. You see the oil, as it settles, it's all still in the 0% tax range. Well, let's keep going. Let's continue to pull from our traditional IRA and 401k, increasing our taxable income for the same year. All right, hopefully you can see this all right, but what happens, do you suppose, when part of our oil here, our long-term capital gains, moves over this threshold line? Yeah, that part, just that part, is now going to be taxed at 15%. But you see that it's moving up. It's the first thing to cross that line. It's not the rest of your income. However much of it is now above that line, just that part, that's what's taxed at 15%. Now, if we add a little bit more ordinary income, you guessed it, a little bit more of those capital gains are going to get taxed. For each additional dollar we add to our ordinary income, these dollars are costing us way more in taxes than whatever our marginal rate is. That continues until all of our capital gains are pushed above that threshold. Now all the oil here is already being taxed to 15%. Adding more ordinary income is not subjecting you to any more of this sneaky torpedo of a tax until you get to the next threshold, which is way up here, which would start this whole thing over again, adding another 5% tax on each dollar of capital gains here. I don't know if you can even see this oil with the light behind it and stuff, but hopefully you get the idea of what I'm trying to demonstrate here, where the long-term capital gains always acts like this oil. The ordinary income is going to settle below, and it's going to push the long-term capital gains to be the first thing to cross that threshold because the government wants to tax it as soon as it can. So anyway, hopefully this helps illustrate. Anyway, let's pull up our familiar chart again. We can zoom in here to get a better look. Now, if you're familiar with the Roth conversion strategy, which we'll talk about in other videos, understanding this tax torpedo can be extremely relevant. Say in this strategy, you decide you want to fill up your 12% marginal tax bracket, right? That's a really low tax. So if we can get some of your traditional IRA dollars taxed at that low rate and moved over to your tax-free Roth IRA, that would be fantastic. Yes, but you have to pay attention to your long-term capital gains here. This hypothetical client had $10,000 of long-term capital gains, and this is how it shows up for him as a tax torpedo. This one's not as straightforward. It's not really going to be the same for everybody, and it's not going to be the same year in and year out because everybody's a little bit different. Your situation will be different based on the amount of your capital gains as well as your other income sources. But see, in this particular scenario, it might make more sense to stop converting at around $64,000 additional dollars. That's where all those dollars that should be marginally taxed at 12% are only taxed at 12%. Above that, more and more of those capital gains dollars are getting pushed above that 15% threshold, subjecting this client to an effective tax rate of 27%. That's higher than the next two marginal tax brackets, and they're really big. Unless you've mathed it out and it makes sense for you to convert quite a bit more than this each year anyway, like well into the 24% marginal bracket, it may make sense to just stop here this year instead. You'll save yourself from paying thousands of dollars to the IRS that you could have easily avoided. As Morgan Stanley says, you must pay taxes, but there's no law that says you've got to leave a tip. But so many do. Let's zoom out here real quick so you can see the next threshold for capital gains tax I was talking about earlier. It's at a much higher income and not as big a surprise. The extra 5% from your long-term capital gains being taxed at 20% instead of 15%. But as with all this, it is helpful to know these things exist. It is not as cut and dry as your marginal tax bracket. And it's not just these three either. They're just the most common, most upsettingly surprising that I've seen in practice. There's also the medical deduction phase out that is less of a torpedo and more like a slow bleed. There's the canceling out of your deductible $3,000 capital losses. The list goes on. But what all these tax torpedoes have in common is that they are triggered by income. And your income throughout retirement is predominantly determined by decisions you are making each and every year, from a few years before retirement to the end. So if your advisor is not helping you consider this when you want to withdraw just a little extra in a given year, or when he or she's recommending or encouraging you to make large Roth conversions, well, they should be. If you're interested in seeing if we would be a good fit for you to help you with this level of detail, you can check us out at spicercapital.com. Learn more about how we work with clients and schedule a time for us to speak. Regardless, I look forward to seeing you around and still helping here on YouTube however I can. I wish you all the best. Take care.